Okay, let's dive into this. We've got the results here for Aarti Drugs Ltd.
Right. The audited financials for Q2 and the first half of fiscal 26.
Exactly, ending September 30th, 2025. And the board just approved these on November 7th, so pretty current.
And we have a good amount to work with the official filings, a press release, and quite a detailed investor presentation, too.
Yeah, full picture. So our mission today really is to get behind those numbers.
Definitely. Not just what they reported, but, how they got there. Especially that margin improvement everyone's noticing.
Right. And also, what's the plan now? They've been talking about this big CapEx cycle. Is it really done? What comes next?
That's key, because it signals a shift in strategy, potentially.
So for you listening, this isn't just about top-line revenue. We want to understand the why behind the profit surge and how they plan to make these big investments pay off.
It's about moving from construction to, well, full-scale production and earnings.
Okay, so let's start with the highlights. Q2, fiscal 26. Consolidated numbers, year on year.
All right, so total revenue, it grew 9%.
Correct.
Came in at Rs 652.9 crore.
9%. Solid, respectable growth. But like you said, that's not really the headline grabber here, is it?
No, not at all. You look further down and things get, well, much more impressive. EBITDA, for instance.
Yeah, earnings before interest, taxes, depreciation, amortization that jumped 23% year on year.
23%, reaching Rs 84.4 crore. So earnings growing much, much faster than revenue.
Which translates directly into better margins. The EBITDA margin expanded, what was it, 150 basis points?
Yeah, 1.5 percentage points, up to 12.9%. That shows better operational performance, plain and simple.
And this carried through to the bottom line too, right? Profit after tax.
Absolutely. Pate was up a very strong 29% year on year, reached Rs 45.2 crore.
So the PAT margin also expanded, 110 basis points, hitting 6.9%.
Exactly. So either they're selling a better mix of products, more profitable ones, or they've gotten, much tighter on cost and execution, or maybe both.
And just to be sure, this wasn't some one-off quarterly thing. The half-year numbers back this up.
They really do. H1 FY26, revenue up 8% year on year. But look at PAT again, up 45%.
45%, that's huge.
Yeah, hit Rs 99.1 crore for the half year. And the margin expansion for H1 was even bigger, 210 basis points. The trend is clear.
Okay, so established fact. Margins leaped significantly. Now, the why. What's driving this?
Well, management gives us a pretty clear pointer. The CFO and COO, Mr. Atish Patel.
Right. What did he say?
He attributed the Q2 results directly to, and I quote, the benefit of favorable export mix and disciplined execution.
Okay, favorable export mix. That sounds like the core of it.
It really seems to be, because there's a sharp contrast painted in the materials between exports and the domestic market.
How so?
Well, they explicitly mention soft domestic demand trends, especially in antibiotics.
Soft is putting it mildly. It seems, looking at the standalone numbers, domestic revenue was actually down 7% year on year.
Down 7%? Yeah, that's a significant headwind domestically.
But they managed to overcome that.
Completely. Because export revenue, on the other hand, surged, up 33% year on year.
33%. Okay, that more than offsets the domestic weakness.
And suggests, a successful pivot. Probably getting better prices in regulated markets, which feeds right back into that margin story.
That makes sense. Higher value products, better margins. But, relying so heavily on exports, doesn't that just swap one risk for another? Global competition is fierce.
It's a fair question, but they seem to be linking it to specific product categories and, again, that disciplined execution. Let's look at the segment breakdown.
Right. Where did the growth actually come from within the business?
Okay. Specialty chemicals. That segment showed the strongest growth rate, up 30% year on year.
30%, okay. Small base, maybe, but strong growth. Rs, 37.3 crore.
Then you have formulations.
Yeah.
Also very strong, up 26% year on year to Rs, 82.4 crore.
And the export connection there.
Very clear. The notes say exports made up 68% of that formulation revenue. So finished products heading overseas.
Got it. And APIs, the core business.
Still a giant, yeah. APIs make up, 79% of consolidated revenue?
Yeah.
That segment grew 7% year on year.
Okay, so slower than the others, but still positive growth on a much larger base, 515.9 crore.
Right. The only segment that dragged was intermediates and others, down 20%. But it's quite small.
And within that big API segment, any interesting shifts, like therapeutic categories?
Well, the breakdown shows their traditional strengths are still dominant. Antibiotics are about 36%, antiprotozoals around 19%. Together, that's well over half the API business.
Okay.
But anti-diabetic is notable at 15.3%.
Right, you mentioned that links to their investments.
Exactly. It's a growing area, and it connects directly to the next big topic, the strategic investments and CapEx.
Okay, let's talk strategy. The big headline here from the CFO again is that the major CapEx cycle is largely behind us.
That's a huge statement for a manufacturing company like Aarti. It means the big spending phase, the construction, is essentially over.
So the focus flips now, right?
Yeah.
From building to running.
Precisely. He said the focus shifts to scaling utilization and converting our new assets into steady earnings contributors.
And they've put a timeline on that.
Yeah, targeting FY27 through FY29 for these assets to really start delivering consistently.
Okay, so let's look at those new assets. First up, the Sayaka facility in Gujarat.
Right, the new amines plant there. It actually started commercial operations on September 4th, 2025, so very recent.
And its strategic importance, it's not just adding volume, is it?
No, it's about backward integration, crucial for securing their raw material supply, especially for anti-diabetic products.
Backward integration, just explain that quickly for listeners.
Sure. It means instead of buying a key ingredient from an outside supplier, you start making it yourself. So you control the supply and, importantly, you capture the margin that supplier used to make.
Ah, okay. So reducing reliance on others and potentially lowering costs or improving margin stability.
Exactly. For metformin, a key anti-diabetic drug, they were buying certain raw materials. Now, with Sayaga online,
They make it in-house.
right, they're already meeting 40–50% of their own internal needs for metformin precursors from Sayaga.
40 to 50% already. That's quick progress.
Yeah, and the goal is ambitious. Meet 100% of their internal demand within the next 6 to 12 months.
Okay, that's a direct hit against raw material cost volatility. Very strategic.
Definitely. And they're doing something similar, though maybe a bit further behind, at Terrapur with salicylic acid.
Right, the salicylic acid vertical. How's that progressing?
They say operations are stabilizing. Near-term output target is 300 tons per month.
TPM. Okay.
And they're aiming to ramp that up to 500 TPM by Q4 of this fiscal year, so early next calendar year.
And that feeds into something else.
Yeah, another integration play. That salicylic acid feeds a downstream salicylates plant they're building, 400 TPM capacity.
So again, replacing imports with domestic production.
That's the idea. Convert import dependence into a controlled domestic supply chain. Again, aiming for margin stability and control.
It's a lot of capacity coming online. Across their 14 facilities, total capacity is over 5,000 metric tons a month now.
It's significant scale. And of course, underpinning the export strategy we talked about is the continuous effort to get EU and US FDA certifications for these large plants. That's the ticket to selling higher value products in regulated markets.
Makes sense. We should probably also quickly mention a couple of other items from the reports. There was an incident.
Yeah, minor note. An HCl gas leak at one unit, T150, back in September. But the regulators gave directions, and the filing confirms the unit is operating normally now.
Okay. And a capital structure change?
Just the completion of a share buyback they did earlier. They bought back about 0.72% of their shares, so paid up capital reduced slightly. That was finished in September 2024, but noted in these filings.
Got it. Okay, let's shift to the balance sheet and cash flows. How's the financial health looking underneath all this?
Pretty solid, actually. Cash flow from operations for the first half, H1 FY26, was strong at Rs 152.4 crore.
And that's after funding the remaining CapEx, right?
Right. They spent about Rs 45–46 crore on CapEx just in Q2 alone, but still generated good positive cash from operations overall.
That seems healthy. What about the balance sheet itself? Did it change much between March and September 2025?
It reflects exactly what we've been talking about, the end of the major CapEx build. Total assets increased slightly, but the big shift is within assets.
How so?
Look at non-current assets. Specifically, property, plant, and equipment. You know, the actual factories and machines.
Okay.
That line jumped from around Rs 856 crore to over Rs 1,066 crore. A big increase.
Right, over 200 crore increase there.
And where did that come from? It came from the capital work in progress, or CWIP account. That's where projects under construction sit.
Ah, so CWIP went down.
Dramatically. From Rs 330 crore down to about Rs 179 crore. So projects got completed, moved from under construction to operational assets on the books.
That really confirms the CFO's statement. The shift from building to producing is right there in the balance sheet number.
Exactly. It validates that whole strategic narrative. And alongside this, total equity also grew nicely, from about Rs 1,369 crore to Rs 1,469 crore. Shows they're retaining earnings.
So, a solid foundation, especially considering their claims of global leadership in some key molecules, nimsalide, ketoconazole, metronidazole.
Yeah, they list quite a few where they claim to be the largest producer worldwide. That existing scale helps when launching new capacity.
Okay, so let's try to wrap this up. What's the main takeaway for someone tracking Artie Bread drugs after this quarter?
Well, the core story for Q2 is clear. They managed to offset softness in the Indian market by really leveraging exports.
And not just any exports, but a favorable, higher margin mix, particularly in formulations and specialty chemicals.
Right. That, combined with disciplined execution, drove that really strong margin expansion we saw. Profit grew way faster than revenue.
But the story is shifting now, isn't it?
It absolutely is. With the major capex declared largely behind us, the entire focus pivots. It's no longer about building, it's about utilizing.
Getting those hundreds of crores worth of new factories humming and generating returns.
Exactly. Management's explicitly targeting FY27 to FY29 for these new assets to become steady earnings contributors. But that's not automatic.
No, definitely not. Ramping up huge new facilities takes time and effort.
And that leads to the provocative thought, maybe. The challenge ahead is immense. They need to achieve efficient, large-scale utilization very quickly.
Especially if domestic demand stays a bit soft and they need exports to keep firing on all cylinders.
Precisely.
Yeah.
So the question for you listening is, how fast can Aarti Drugs really turn this newly built capacity, the internal metformin supply from Sayaka, the stabilizing salicylic acid vertical at Terrapur, into consistent, predictable quarterly earnings? Can they maintain that crucial export momentum quarter after quarter?
That utilization rate, getting those plants running efficiently and selling the output profitably, that feels like the #1 thing to watch going forward.
Absolutely. That's the next chapter in their story.